Fantastic. So hello, everyone, and welcome. My name is Lachlan Pollock, and I work for the Institute of Community Directors Australia, or as we call it, ICTA, helping to manage our online training program. I'm so pleased to see so many faces on my screen today, and there's a few faces that I recognise from yesterday. So if you're joining us again after attending questions your board should be asking about the finances, it's great to see you again. But if this is your first webinar for the week, it is also lovely to see you. I'd like to kick things off by acknowledging the traditional owners of the land that I am on, the Wurundjeri people of the Kulin Nation, and pay my respects to their elders past and present. I'd like to extend this respect to the traditional owners of the lands from which our audience are joining us from for today, wherever that may be. So thank you again all so much for joining us today. Before we get started, I just have some brief housekeeping. We have lots of people on the line, so we're going to try and get to as many of your questions as possible throughout the session. There may not be time for all of them, but we do want to hear from you. This is an Ask Me Anything, so our presenter is really keen to hear from you all. Please use the chat function to ask these questions, and I'd love your help in ensuring that the most relevant questions are being asked. So if you could use the reaction function in the chat to either thumbs up or love heart a message, that will just let me know that that question is on a few of your minds. The recording will be sent out later today, and it'll be available for a couple of weeks. We'll also have the slides to share with you at the end of the session, and there'll be a survey too. So if you could fill that out, that'd be great, as it helps us to better tailor these presentations in the future so that they meet your needs. Now, I know you're all keen to get started, so it's my absolute pleasure to introduce you to Professor David Gilchrist. Professor Gilchrist has worked in and around the human services sector for 30 years. He has held executive roles in, consulted to, and been part of the governance team of various charitable human services organisations, including in disability services, aged care, and child protection. In all of these areas, David has contributed to policy and practice. Prior to joining the Academy, he was Assistant Auditor General for Western Australia and has taught at London School of Economics, Portsmouth University in the UK, and Curtin University and Edith Cowan University here in Australia. David has researched in the areas of non-profit sustainability, economics and governance, and has written over 100 industry reports and papers focusing on key issues related to the sector. He is also a visiting fellow at Queensland University of Technology School of Accountancy and visiting professor Erlangga University in Surabaya, Indonesia. David was made a Fellow of the Parliament of Western Australia in 2021. Today, David is going to go through some pre-submitted questions that a few of you will have submitted over the last couple of weeks. And then at the end, we're going to have time to open it up to everyone in the chat. So David, thank you very much, and over to you.
Thanks very much, Lachlan. Can everyone hear me all right? Or yep, so fantastic. That's wonderful. I too, before I do anything else, would like to acknowledge and pay my respects to elders past, present and emerging of the Whadjuk people of the Noongar Nation here on the western side of the Australian continent, but also to extend that acknowledgement and respect to all of those First Nations people from whose lands people are participating in this session. I'd also like to say that it's been a little bit of a scary run up to this session because when Lachlan proposed the title of Ask Me Anything, that scared me more than a little bit. And there's been some LinkedIn and other traffic that has kind of suggested that my worry has been well-founded in some respects. So I guess there's two things that I would say in the context of this presentation. The first one is that, of course, I would be delighted to try and answer as many questions as possible and to provide you with my view on the approach that might be taken with problems that you might present with, but also to say that if I ask you to come offline or to talk outside of this session, I'd be very happy to at least point you in the right direction if I can't help you immediately in relation to this session. And so the second thing I wanted to say is that I'm working off 3 screens in this session. So if you see me in profile, rather than looking down the camera, you'll know that I'm still here and not answering email, I promise, but trying to make all of the technology work. So I hope that works. In the first instance then, I would like to simply provide a note. We're obliged from ICTA's perspective and also UWA's perspective to provide this note. First and foremost, as you can see, this session is intended to be a discussion of general issues focusing on non-profit charities and finance. It is based primarily on questions that have been taken at face value, and no investigations of the general or particular circumstances have been undertaken, nor have any discussions been held with questioners. So I've only got what I'm going to share with you as far as information goes in relation to the questions we have today. The third element is that it's my responses, of course, are intended to be very general in nature and don't constitute any advice whatsoever. And this caveat extends to both the UWA Centre for Public Value at UWA as well as ICTA. And then finally, I think it's important that you get advice pertaining to your issues and your organisation might be facing, so that it's specific to your circumstances. And I'm sure you understand that I have to put that forward. So what I want to do is to respond to a group of questions that have already been provided. And I've done two things in relation to those provided questions. Two questions I've actually taken out of the list, so to speak, because I felt that I was unable to provide any general advice on those, and I'd be very happy to talk to the two people that sent those two questions in. The other questions that have been retained and which I'm approaching, I think, are good questions and topical questions that extend across the charitable and non-profit sector. And I think a lot of voluntary people, as well as executives and others in the sector, would find the answers to those questions quite useful. So my plan is to step through those questions, of which there are 5 or 6, and then, as Lachlan said, to take any questions on board. I'm really happy for you to put things into the chat site and to be able to let Lachlan know, particularly if there's a question pertaining to a slide that I'm on, so that we get them as useful as possible in terms of answers. However, the first question, as you can see here, are there any limits on profitability or current assets that apply to not-for-profit sporting associations? The short answer here is no on both counts. Not-for-profit organisations and charitable organisations are entitled to create a profit. And I would argue, in fact, that they need to create a profit in order to be sustainable in a markets-based economy. Making a profit means that you're actually building the balance sheet of the organisation, which allows you to be solvent in the first instance, so in the short term. In the medium term, to be able to respond to strategic and other implications for the environment in which you're operating, particularly where government and others might change policy frameworks and so on, and you have to invest. And in the longer term, those profits are used to replace assets, and increasingly the dollar for philanthropic donations of assets, as well as lottery systems assets donations, are becoming harder and harder to get. And so to that extent, I think it's really important not only that your organisation makes a profit, but it has an appreciation of the level of finances required in order to ensure sustainability of the organisation in the short, medium and longer terms. I also think that, and I'm on a soapbox now, so I'm really happy to be knocked off it if people have a different view, but I do think we have not helped ourselves in the sector generally by advocating for surpluses and deficits. A profit is not a surplus. In accounting terms, a profit is a reinvestment in the balance sheet and builds the wealth of the organisation to be able to maintain that sustainability in the shorter, medium and longer terms. A surplus, on the other hand, is really saying that you are not needing the money that you've generated, that money is extra to what is required by the organisation. And it's very old terminology that goes right back to when charities and not-for-profits were largely trust organisations 100 or so years ago. I think we need to change that perspective, and I think we need to talk about profits, because it is fantastic for charities and not-for-profits to make profits. And I think there are a lot of people, particularly not engaged in the sector, that would say things like, well, not-for-profits aren't supposed to make money, which means that at the end of the day, they're not going to be financially sustainable. So that's all I wanted to say on that one. And I'm happy to talk a little bit more in question time, but at the end of the day, there are no limits. Where the limits lie are that not-for-profits and charities in general terms can't distribute profits and can't distribute net assets on termination of their organisation. Beyond that, they can make it be as profitable as they possibly can be. And my view is that you should be as profitable as possible within the remit of pursuing your mission of the organisation. The second
before we move on to the second question, there was a question that came that I think is somewhat related. In a high-risk funding environment, how much should an NGO have in reserves, and what is the usual ratio of admin costs in the budget to delivery?
Wow. So that's a really how long's a piece of string question, and I'm really reticent to provide hard and fast figures. But I would say there's two things to consider in that regard. The first one is that it's my experience, and I think most people in the room would agree, that government funding, particularly for services procured, is never sufficient to cover what we call the comprehensive cost of service delivery. So all of the costs, and indexation, inappropriate indexation formulas and other processes have meant that over decades that underfunding has existed. What does that mean in the context of that question? It means that organisations need to really know themselves. They need to know what the comprehensive cost of service delivery is in order to understand what the financing gap is, in order to then understand what the value is in terms of the finance required in the short, medium and longer term. And often organisations are able to maintain their solvency through funding arrangements, but they're not able to respond to policy changes, not able to reinvest in the organisation to train staff. And certainly, I think there's an enormous gap in terms of technology uplift and capacity in organisations for undertaking things like performance reporting. So everyone's talking about how not-for-profits and charities need to report on their performance and their impact and all of these things. All of that costs money, and that money needs to come out of the profit generated by the organisation. So there's a big gap there that needs to be understood by organisations in order to appreciate what that profit gap really is. The second thing that I would say is that, generally speaking, and this is very general, so don't take it to heart, but we would say that about 70% of expenses of an organisation in the not-for-profit and charitable sector in Australia are constituted by human resources costs. And we would say that probably another 10% of those costs relate to what we might call direct service delivery costs. And so about 20% tends to be around that administrative cost for organisations. That's a very, very general, very rubbery rule of thumb, but they're the kinds of numbers that I think you need to be identifying within your own organisation in order to get to know yourself, in order to be able to understand what that gap in funding is. Does that answer that question, Lachlan?
I can see the person who asked the question is nodding and put their thumbs up. So,
right.
Yeah.
Great,
Good.
that's fantastic. And I notice a fair few people taking notes, which is great, but the slides will be available at the end of the session as well. So please, if you're happy enough with that, that will do the trick. The second question has actually been reworked a little bit because it was a question that I think needs to be dealt with, but one also that I think is a really critical question for people to understand what it means to be misdating documents or misusing documents in the context of administration and governance of a charity or a not-for-profit organisation. Again, this is very general, but this charity sent through a question that kind of put up this proposal that postal donations received during the first week of July are marked as having been received at 30 June, obviously for tax deductibility from the donor's perspective in relation to that organisation. And that backdating of the DGR receipt allowed that donor to be able to claim a tax deduction prior to the financial year, even though that organisation was receiving those funds in the new financial year. So the question put by this organisation in the first instance was, is it acceptable to backdate the DGR receipt if the amounts involved are not material? Is it compliance with tax requirements and accounting requirements for revenue recognition? Well, there's a few things here. Number one, backdating of any documents is generally not acceptable. And so backdating of receipts or tax information is essentially a fraudulent act, to put it bluntly. You can't backdate receipts and things of that nature. You must receipt them on the day in which you receive that particular donation. Secondly, though, the question talks about the amounts involved being immaterial. They may well be immaterial in terms of the size of the organisation and the relative size of the income for the organisation or what have you, but materiality doesn't really give you a get out of jail card in terms of committing a fraudulent act. So again, post-dating or predating a form or anything of that nature, not just in relation to tax records, but in relation to any records, is not acceptable from the point of view of undertaking a fraudulent act, regardless of the size of the transaction, regardless of the importance of the document. The other thing to note, so I would argue, no, it's not compliant with tax requirements, and it's not compliant with accounting requirements, because at the end of the day, revenue recognition from the point of view of receiving cash occurs when you actually receive cash. It doesn't occur at any time before receiving cash, even if it's administratively convenient to do it that way. The second issue, I think, in relation to the tax requirements is that when you receive, or rather the accounting requirements, is when you have an auditor looking at cash inflow, they should be really concerned if cash comes in on one date but is dated to have come in on a previous date, particularly if that's in relation to a change in financial year, because that should give the auditor concern about the content of the financial report that they're auditing. In other words, I think you're lining yourself up for difficulties with the auditor. Even if it's an immaterial amount, the auditor should be looking at that very closely. If the auditor's not looking at that, it might be time to look at your auditor and whether or not you have the right auditor for your organisation. Anything come through on that at all, Lockie? No?
I think we'll push on.
Push on. So the second part of that then was a second question, or a part B to the question: is it acceptable to shred cheques and credit card slips received in the mail after processing the payment, or do they need to be retained securely for record keeping or audit? I suspect most people in the room have already identified the answer to this particular question. Setting aside that I regularly have to explain to my classes what a cheque is, I see by the faces on the screen that probably most people are familiar with that finance option. But at the end of the day, no, any financial documentation that might have an impact on the audit, have an impact on the financial reports of the organisation, or have an impact on your relationship with the tax office need to be retained for at least 5 years. So the Australian Tax Office has various retention requirements depending on the type of tax return, the type of entity you are, and so on. But generally speaking, you must provide your, you must retain your records for 5 years as relates to any financial transactions that relate to your organisation. So shredding anything that comes in after it's been processed is not really acceptable from the point of view of the tax office, for instance, much less from the point of view of the board of the organisation, who should be keeping records sufficient to be able to meet the requirements of the tax office up to 5 years ago. Okay, so question 3 then. I run my charity from home and I would like to know how I can claim a percentage of rent, electricity, internet and other expenses I personally paid for to run my charity. I do not know the tax rules in regard to percentages when running business from home. So this is a really pertinent question, not just for someone who's running a charity out of their front room or whatever it happens to be, but also it's pertinent because, of course, many people in the room will have staff that work from home regularly, given the advent of COVID and the change in our working culture that has seen more and more people work from home. So there's 2 issues here. The first issue is whether you are claiming or seeking to claim a tax deduction for costs that relate to running of the charity or undertaking your work in home. The second is whether or not the charity reimburses you for those costs. And there's two separate elements. The first one I'm going to deal with is the reimbursement of costs. If you have a charity that's prepared to reimburse you for costs for working from home, that charity needs to create a policy. And that policy needs to deal with the tax implications of that for the employee. It needs to deal with what kind of records need to be kept in order to make sure that the auditor and the tax office ultimately are happy with the arrangement put in place. And it also needs to have a policy framework for deciding how costs are allocated in order to be able to reimburse those costs. So for instance, if I work from home, I might want to have reimbursed water costs, mortgage costs, electricity costs, heating costs, and so on that relate to running my study. I might have a 100 square metre house and my study might be 10 square metres. Therefore, the policy might be that 1/10 of those costs are able to be claimed from my employer as a result of undertaking my work at home. That might be even more important in the case where charities try to get staff to work from home in order to reduce the requirement for rented accommodation and other overhead costs that go with that. So there's nothing wrong with doing that, but that documentation is absolutely critical. If you are claiming your expenses from the tax office for working at home, which a lot of employees do, there's two further things that need to be thought through. The first one is whether or not you, in claiming those costs from the tax office, you're also taxed for any reimbursement from your employer. I'll set that aside because that's far too difficult and specific to talk about in this session. But the second is, if you are claiming from the tax office in relation to your salary or your income from that particular charity, then you need to keep records in relation to the nature of those costs. But there's two ways that you can actually claim. The first way is what we call the fixed rate method. And under the fixed rate method, you can claim 67 cents for every hour that you work for your employer at home. 67 cents for every hour you work for your employer at home. But of course, you must keep records of how many hours they are. And it's very, very good if your employer confirms those hours in terms of any potential tax office audit. The second way is what we call the actual cost method. And the actual cost method occurs by undertaking calculations similar to that I just mentioned in my instance, where 10% of costs have been claimed as a result of 10% of my, or rather 10% of my house footprint is taken up by my home office. If we take that second method, the cost method, then we need to keep all of the invoices for things like electricity, etc. And we also need to document how we proportion the value of that cost against our amount being taken. Things like council rates and taxes can also be included in those costs, of course, but you need to be really careful. Increasingly, governments are sharing information, and you might be working from home, from a home office. Technically, you can't do that without council approval. So in other words, you have to have a registered home office or have a council approval to be able to do that. If that's the case, then you might find yourself in trouble as a result of claiming this amount. But you need to be aware of those things. I can't say specifically that they will apply. Okay, question 4, if I can go to question 4. So a discussion around accounting and tax implications for in-kind donations would be great. This is the holy grail of accounting in not-for-profit and charitable areas. So as we all know, many organisations rely on in-kind donations to be able to survive. And those donations might be a lottery system donating a building or a capital asset like a motor vehicle, a bus or something like that. Or it could be individuals donating time. So volunteerism comes under this as well. And how do you account for these items? In the case of the former, where someone donates an asset in kind, then you are able to identify income in relation to that asset and create an asset in your balance sheet on the other side of the coin, so that if I donate a bus to your organisation, you're able to recognise the income and the asset associated with the receipt of that bus, because What's happening? The organisation has greater financial capacity or capacity to earn as a result of having that particular asset. How do we value the asset? Well, that's a great question. But at the end of the day, typically we value that asset by recourse to the market. We know how much a new bus costs. We might even know how much it costs to modify that bus to make it useful to our organisation and the kinds of things we get up to. Similarly, if a building's built, we know how much the contract for building the building was, and we're able to use that to value that item. What becomes really difficult is the provision of items that aren't associated with markets, because we need to then make a rule of thumb valuation, and the directors are entitled to make that valuation according to their perception of what that might cost. A good example of these kinds of things includes, for instance, the reinstatement of a church. And churches are really difficult to value for obvious reasons. There's not a standing market for churches. There's not necessarily an alternate use for churches. And we don't necessarily want to replace or sell churches. It's very unusual for churches to be turned into accommodation or something else. And so it's up to the directors to be able to make the valuation and to decide what the income received is going to be and what the value is going to be taken to the asset on the balance sheet. Now, there's a couple more things that might be important in that regard. The first thing is that with those kinds of assets, you need to determine whether they are controlled or administered assets. A controlled asset is what I might call a typical asset, what we would generally call an asset, a motor vehicle that we can use in our business, in our organisation, but we can also sell it if things get tight. We can do what we like with it. We can park it in the garage and not do anything with it, come back in 2 years' time. That's a controlled asset. An administered asset, on the other hand, is more typically provided by a donor, a philanthropist, or a lotteries system, where the lottery system, for instance, might donate a building, but that building is not able to be sold or used for any other purpose than that for which it's donated. And should you not wish to use that building anymore, you might have to hand it over for free to another charity or hand it back to the funder. That's an administered asset, and that has particular impacts on the solvency of your organisation, because, of course, you can't sell that business to be able to pay bills if you need to do that. I think the other aspect that's important in relation to this is valuing volunteer hours. And this is a really difficult thing. And it's difficult on two grounds. Number one, that you might ask, well, is it worth it? And I'll come back to that shortly, because you need to make an assessment about what the value of those hours are, and you need to record the value of those hours as both income and expenditure. So the net effect of the transaction is zero. But coming back to the valuation side, typically we would say we would value by recourse to the market in the same way as we value assets by recourse to the market. And that is typically if you have someone that's undertaking, say, voluntary reception duties, then the value of their contribution is the hourly rate of a receptionist that you might find in commerce. Now, that receptionist might be a retired lawyer with 30 years of high court barristing under their belt, but it doesn't matter the fact that they're really overqualified for that role. It's the valuation of the role that is important. And so there are methods of valuing. The accounting standards allow you to determine that you are going to incorporate that as income and expenditure on your profit and loss report. And so you're able to record that if you want. There's some circumstances around that, and I won't go into that very deeply, but I'd be very happy to answer that out of session. The other aspect in relation to valuation is, why might you do it? And this is a bit of a soapbox for me, because a lot of organisations who are funded by government procurers to provide services or supports in, say, human services area like aged care and so on, might provide their tenders or be attempted to provide their tenders without costing in voluntary labour. And this, at worst, is an under costing. So that's built into the costing framework of governments and the expectations of governments over time. So they underpay or expect to underpay for services, but also it builds in a risk in your organisation, because if you can't get volunteers, and we saw this in COVID, where you couldn't get volunteers. And so you have to either hire people in which case you're out of pocket for those services, or not deliver the services, in which case in the markets arrangements we have now, you're unable to deliver services and therefore unable to get paid. There is a real risk associated with this kind of activity. So I think it's really important for you to be valuing the volunteer time based on the service that the volunteers are providing, and costing that volunteer time into tenders, even though at the end of the day, you might be lucky enough not to have to pay for those hours as you go forward. Again, really happy to discuss that, but I think that's a really important aspect or issue in relation to this particular question. Where director sitting fees are allowed to be paid by organisations' constitution. What are the accounting and tax implications of these payments? Well, there's a couple of things that are really important in this regard. The first thing is that absolutely directors' sitting fees are able to be paid. There's no prevention of directors being paid. My personal opinion is that if you can pay directors, then you should be paying directors, because I think that makes a big difference to the final outcome in relation to their capacity for contributing to your organisation. That's another discussion though. What are the accounting and tax implications? The accounting implications are twofold. When we pay directors, we essentially say directors are employees of the organisation. Why do we say that? Because a director is providing their personal services, their experience and their capacity to support the organisation in that governance role. And so they're employees. As employees, then, from an accounting perspective, you need to be recording those director expenses as part of the human resources cost of the organisation in the P&L. You also need to record the fact that they might be getting fringe benefits. So it's not unusual for directors not only to be paid, but they're entitled to get access to fringe benefits, concessions that charities are able to get access as employees of those organisations. From an accounting perspective, though, it is really important that you also declare or are transparent in what kind of information you provide to demonstrate that directors are being paid. Now, that doesn't mean that you say David Gilchrist gets $10,000 a year as a director, or $1,500 a meeting, or whatever it happens to be. There are different ways that you can provide that information, but you do need to declare that those directors are actually being paid and show how they're being paid. You might also, though, declare, because it happens quite a bit, the directors not get paid, but they donate that payment back to the organisation. And it's absolutely valid and appropriate for you also to declare or to show in your financial report, not only did the directors get paid, but they donate that money back to the organisation, so that you can see the net effect is zero from the organisation's perspective. The tax implications then are exactly the same as for any other employee. If they are paid in fringe benefits tax, they must make the statutory declarations, and you must include that information in your return. If they are employees, you must deduct PAYG from them. If that's their only job, then of course they're entitled to the declaration in relation to their tax-free threshold. All of those things apply in exactly the same way as they apply to an employee. Now, there has been a subsidiary question to this question, which was discussion around directors' fees in general terms would also be good. I propose to shift that to the general discussion, if that's all right with everyone, because I think there's a lot in that discussion, and it'd be great to be able to kick that around. The final question then, I think, is because we are a trust, on us, the penultimate question. Because we're a trust, we do not qualify for grants from organisations such as Lottery West, so the West Australian lotteries system. Is there any legal way, without jeopardising our existing charity status, that we could create an incorporated proprietary limited subsidiary that would qualify for such grants? This is, I was keen to have this question in because it's actually asked quite a bit, because there are a lot of trusts that have been developed historically that are still extant and still operating. Trusts used to be much more common in terms of the charities and not-for-profits world. They're becoming less and less common, primarily because a trust is not a corporation in the way that an association or a company limited by guarantee is. And that's one of the chief reasons I would expect that funders and philanthropists don't want to deal with trusts, because they're actually effectively dealing with individuals. In this particular case, there's probably a couple of things that I would say. First and foremost, I reiterate the caveat that this is very, very general. We're not giving advice. And of course, there are specifications that relate to the trust deed and other things that need to be thought about in the context of what I'm just about to say. But the short answer is it's very difficult to be able to retain the trust and rely on the trust DGR status to be able to access grants, but to use another body to access those grants. One way might be, and I underline, and in my mind, might is written in capital letters, there might be a way by actually having a corporate trustee as trustee of the trust rather than having individuals as trustees of the trust. And that corporate trustee might be an incorporated association, or it might be a company limited by guarantee. I wouldn't have a proprietary limited company because the purpose of a proprietary limited company is to create profit and to be able to manage the entity. I think makes that a little bit more difficult in the context of ACNC registration processes and so on. However, I think probably you're going to have to establish an association, an incorporated association or a company limited by guarantee, and go through the DGR application process again to be able to achieve the outcome that you're looking to achieve. As I say, it might be worth talking to Lottery West or philanthropists about the idea of having a corporate trustee to run the trust and see whether that makes any difference in terms of their approach to that particular trust. Okay, the final question then, question 7, what are the biggest pitfalls that NFPs should be aware of and how do we best mitigate against them? Okay, this is a fantastic question if I want to speak for another couple of hours, and I'm quite happy to do that. I can do that if people would like to, but I know that everyone's got enough on their plate. I guess I would say that in accounting and finance terms, so there are many, many pitfalls with NFPs and charities, as there are every organisation that operates in a market economy like that of Australia. But the key pitfalls I see that are not being talked about. So these are things that I think are really important issues, but that go beyond things like ESG requirements and so on. The first one, and in no particular order, is that of calculating depreciation properly and comprehensively incorporating depreciation as part of the cost, the comprehensive cost of your service delivery, so that you understand the gap between your profitability and the actual profit being generated by your entity. Depreciation is often thought of as just an accounting adjustment or just a thing accountants do and nothing to do with operating the organisation or its solvency over time. But depreciation is a critical estimate of the consumption of the assets that the organisation has. And in my experience, the opportunity for receiving philanthropic or other grants to be able to replace assets is becoming harder and harder and harder, and profitability is going to be required for organisations to regenerate themselves going forward. So I would look at that as being one element that I think is really important. The second element that comes to mind relates to employee entitlements. And I increasingly see organisations not managing their employees' leave closely enough and requiring their employees to take leave. And there's two reasons for this fundamentally. The first one, and most obvious, is that, of course, employees are very hard to come by in the modern economy. And that means that if you are struggling to replace employees while they're on leave, then you're going to struggle to be able to invoice your clients and so on and so forth. But secondly, people try not to have their staff take leave in order to manage imminent cash flow issues that they might have. And this is a really difficult question, but at the end of the day, employee entitlements that build up are a big risk to many organisations' solvency, because ultimately those amounts have to be paid out. Ultimately, those amounts are paid out at some future cost of employee wages and salaries, not at the present cost. That means that not only is there a gap in terms of what your estimate of the cost was, but there's also a gap in terms of your tendering for employee costs, amongst other costs, in relation to the financial reward or payment that's made for services that you might provide to governments or others. In other words, you're getting paid today in today's money at today's rates for an expense that's going to be paid at tomorrow's money in tomorrow's rates at some future point in time. So you've got to be really careful about that. I see many organisations that I worry over the next 5 years are really going to be in significant financial turmoil if they fail to have reserves set aside. Redundancy is also a big issue. As we know, many organisations are part of the industrial state that requires redundancy to be paid to people when there are programs that close. And I find that the accounting standards don't support not-for-profits and charities in relation to this issue, because in terms of accounting standards, redundancies are not, or provision for redundancies are not able to be accounted for. And that leads people to not account for or put aside reserves for that eventuation. And I think it needs to be reserved because I think it's a really significant cost for people running their organisations. Not only is it a significant cost, though, that also needs to be incorporated into tenders going forward. So not only do you put your leave and other costs into your tender documents, you also need to put a provision for redundancy in those documents as well and communicate that to government so that they understand what the value of longer term contracts is for their organisation. The longer the term contract, the less likelihood of redundancy being required to be paid, the less cost to the funder in relation to that. Now that takes us right back to Lachlan reading out the question, a question that is germane to this question, and that is in relation to reserves. Organisations need to have reserves, but there's a political problem with those reserves, as I'm sure you're all aware, which is that philanthropists and funders of all different stripes look at your balance sheet, see that you've got money, and then make the ginormous leap that you don't need any money because you've already got a bank account full of dough. And so why do you need my dough? And I think that there's two things that I would say about that. In terms of reserves, again, it's not possible for me to say you should have 20% of your turnover or you should have 3 months operating money or whatever it happens to be. But I would be more inclined to say, have your cash set aside that is labelled, for instance, employee entitlements and provision for redundancy. Now, two things further I want to say here, and I hope I'm not getting too accounting, but at the end of the day, the accounting standards don't let you expense provisions that are not imminently going to be paid. So the reason redundancies can't be expensed in accounting terms, accounting standards terms, is because we don't know if they're going to be paid or not. There's not enough definicy about the liability to allow those to go onto the balance sheet. And that's fine. You can't expense them, but you can carry them. In other words, your auditor and everyone else involved should not be concerned if you have against a bank account a label provision for employee entitlements and redundancy. And that communicates to your funders and others that actually that you do have money, but that money's set aside for purposes. So you're not entitled to expense that provision, but you are entitled to carry that provision. And so I think that's a really important thing to be aware of. I think communicating to funders what that money is set aside for is also a really important thing, because then you're not going to have people saying, hey, you've got all this cash, I don't want to pay you. The third thing that's really important in all of this, and which I also think is a common pitfall for not-for-profits and charities, is that not-for-profits and charities fail to separate their internal reporting from their external reporting. And so they apply accounting rules and what the auditor would like to see to their internal reporting and reduce the capacity of their internal reporting to tell directors and others what's going on within the organisation. And that's particularly true of things like redundancy provisions. You can't display, you can't recognise redundancy provisions on public accounts if you're conforming to the Australian accounting standards, but you can use them internally. You can calculate them internally. You can see how much they are costing you internally. You can see what the size of your risk is internally. So there's no problem with that. Now, I've gone a little bit over time in my response to questions. Lachlan, any questions in the chat?
There is, David. Thank you very much. I might just quickly ask this first one that is related to that question 7 that you were just answering there.
Yeah.
And that is employees' entitlement and HR practices should be stipulated and complied with FWA and their award terms and conditions. Should all not-for-profit orgs be under an award?
Well, look, again, I can't really answer that with any specificity, but at the end of the day, it really depends on the state and Commonwealth industrial position. It depends on Fair Work Australia impacts. It depends on how your organisation is incorporated. And it might even depend on how you're funded. So different coloured governments have different industrial requirements that might be attached to grant funding and so on. So the short answer is no, you don't have, not everyone is in the same boat. So you need to explore exactly what your options are in relation to that. And most importantly, in the context of those options, of course, what is going to be most supportable and sustainable from your organisation's perspective, and what is going to be able to, wherever possible, help you to compete for labour in the current environment as well.
Thank you very much, David. I thought I'd just take a quick moment as well. I've had a few questions in the chat about yesterday's presentation. I'm just in the process now of putting the recording for that up online, and I'll be doing the same for this as well. So you can find that at the Not-for-Profit Finance Week webpage, which I'll quickly send in the chat now so that you all have that good to go. And we will get back to the questions now. On the topic of questions as well, feel free to keep sending them in. And I also just want to note that there are some people who are answering each other's questions in the chat. So it might be a good place to go if you want to check there, because some of the ones that have been answered, we will skip over and get to the other ones to David. So thank you, everyone. The next question we had here is, could you shed some light on the recent changes to self-assessment regarding income tax for not-for-profits?
Yeah, so this is a really interesting development. I think, number one, with an election year coming up, we should all be writing to our MPs and telling them that this is an unacceptable development, because I'm not really sure it's going to help the sector or the community to be able to achieve any outcomes. But essentially, the non-profit organisations, so not charities, this doesn't apply to registered charities, it applies to those non-profits that are not registered with the ACNC. It also applies to those non-profits that are identified by the ATO, which are essentially about 187,000 non-profit organisations that have an ABN. So if you have an ABN and you regularly submit an annual information statement, then you're probably captured by this requirement as well, which is to submit what is effectively a return to government on an annual basis that essentially says to them how you have maintained your non-profit status, what you've done and how you've done it. So it's essentially a declaration that to help the government or the ATO feel confident that non-profits are actually acting non-profit in the pursuit of their mission. You'll be contacted if you need to make that submission. They've got your details in that regard.
Right. Thank you very much, David. The next question we had here is, can you give some guidance on how to reflect pledges extending over a number of years so that there's transparency for directors where funding may cease and a distinction between new versus prior funding?
Yeah, so there's a couple of things that I would say. Firstly, pledges are a particular issue or a particular thing in the context of not-for-profits and charities. In America, if you make a pledge, then there's as good as a contractual arrangement in place. In Australia, if you make a pledge, there is no contract. It's not until either you sign a contract for funding arrangement or that you actually pay the funds over that there is a contract in place in relation to that particular process. So first and foremost, typically we don't record pledges in this country. We don't typically recognise pledges, but you can incorporate in your financial accounts notes to the accounts that might describe pledges that have been undertaken by particular funders or particular organisations. And you might also describe how those pledges might work so that you could have, David Gilchrist Inc. has been kind enough to pledge $10,000 a year to I don't know, undertake gardening around our aged care facility. In which case there might be a contract in place, and that's great, or there might be just simply a pledge, which the publication of those details might ensure that I honour my obligation in relation to that particular pledge. But you can only really have it in the notes to the accounts. And for an account, any accountants in the room, I'd treat it similar to a contingent asset. So a contingent asset, like a contingent liability, has no definicy around its occurrence, but it is something that we feel the users need to know in order to appreciate the full financial environment in which we're operating in.
Terrific. Thank you, David. The next question we have here is, what are the legal and financial implications of renting out parts of your building to other organisations?
Well, the implications are that you are operating, there are state and territory obligations as landlords, as I'm sure you're all aware, and I won't comment on those, but they relate to the kinds of conditions that the contract might have and the way payments might occur, etc. But there's also tax implications in the context of making sure that you are recording rental income as income on your ABS, or AIS rather, and that you are noting that as income on your financial accounts. Beyond that, there's not really a great deal of impact, providing, of course, the financial results of that rent are applied to the mission of the organisation. In other words, they go back into your consolidated revenue, and you're undertaking your mission activities as a result of that activity, if that makes sense.
Thank you very much, David. I'm also just going to pop into the chat. We did a webinar we're doing a webinar, sorry, on the 14th of November on hiring, leasing and subleasing for not-for-profits. So I'm just going to pop that into the chat. If you want to know more about the legal implications, that will be a good place to go. We're going to jump back into leave now, as you were talking about before, David. The question is, may we know about the recent rules for casual employees on long service and sick leave?
Say that again, I'm sorry.
May we know about the recent rules for casual employees on long service and sick leave? If we're not sure, we might take that one on notice, and I can...
Yeah, I'd prefer to take that on notice because it has implications for the way you're employing people, and it has implications in terms of the type of organisation and the awards and other things that you operate under. So I think that's better to be... I'd rather not mislead people.
Great, thank you, David. And I can see that somebody has popped in a link underneath that comment in the chat to the Fair Work Ombudsman changes for casual employment laws. So if you are up to that, then you'll be able to read that there, and you can reach out if you have any more questions, and we'll try to get some answers for you. Now, I'm just looking through the chat here, David, for... here we go. Can you please clarify if retained earnings can be used to purchase property or assets, and does it reduce the balance of retained earnings?
Retained earnings are, and again, this is very, very general, but retained earnings are just the balancing element from the changes in assets and liabilities that occur over a reporting period. So retained earnings are not used for purchasing things per se. It's not like with a commercial entity where retained earnings can be reduced as a result of dividends being paid out, for instance. At the end of the day, you can use your untied funds, so funds that you have entitlement to use however you wish to use them, to purchase whatever you need to purchase in order to pursue the mission of the organisation. And that includes in relation to businesses. Typically, you wouldn't have the amount of cash you hold being exactly the same as retained earnings in the organisation, for instance, because it is that balancing item between assets and liabilities.
Fantastic. David, thank you so much for taking time to answer these questions today. I hope everyone feels happy that they've had their questions answered. And if you do think of anything else, please do reach out to us. But yes,
Okay,
David.
can I just make one more statement? Sorry, I'm just looking at the questions here. One of the things I just wanted to make sure people were clear on as well is that it can be a pitfall, a trap for people who are paying directors to associate the payment of directors with the profitability of the organisation. In other words, like a commercial entity, you might have a profit sharing arrangement where once the organisation makes profit, then there's a bonus to directors of 10% of that profit, for instance. Charities and not-for-profits can't do that. You cannot associate payments of anyone with the profitability of the entity because that's distribution of profits and that negates your charitable or non-profit status. So I just wanted to make sure that was everyone was clear on that because I think that's an important issue.
Thank you, David. It looks like one more question has just popped in, so we might get to that before we wrap up. The question is, can I please get general advice on royalty payments and taxation requirements? Do we want to dig deeper into that one at all? We could get Annie to come off mute to...
Yeah, that'd be great.
Yeah. Annie, if you could put your hand up just so you come to the top of my screen, if you're happy to talk, that is, of course. Perfect. Thank you. I will ask you to unmute now.
Excellent. Thank you very much, Lachlan, and thank you very much for all that advice, Professor. Just to give you some context around the organization that I am currently working at, we are a subsidiary to an international holding company. Due to the business relationship, we pay a payment called royalty payments. I'm kind of searching through some general advice where I could get external advice on taxation implications and what sort of requirements we should be complied with.
I'm less worried about the taxation impacts and more worried about the external transactions obligations you have in terms of money laundering and those kinds of things. If you are happy to chat offline, I'd be happy to give you some suggestions of who to talk to in that regard. But it's making sure that you don't fall foul of our anti-money laundering rules and so on is the important thing.
Absolutely. How can I actually connect with you, Professor?
Sure. If you put David Gilchrist UWA into the Google machine, it'll spit out my email address. And if you send me an email, I'd be delighted to chat. If not, if you can't find it, go to Lockie and he'll be able to send it through. But I'd be delighted to chat with anyone in relation to anything.
Excellent. I will try all the avenues to reach out to you. Thank you very much.
My pleasure, Annie. Thank you.
Thank you very much, Annie. David, I'm sorry, that is all we have time for the questions that are still there. I am really sorry. If you do have a burning question that you do want to ask, please do send it through to me and I'll try and get an answer for you as best I can. You'll just be able to respond to the email that comes out later today with the recording and the slides. So please do send that through. Before we wrap up, I do want to just quickly send into the chat the survey link. You'll receive that later this afternoon as well. But if you could please take a couple of minutes, that would be absolutely fantastic. We'd love to hear from you and we'd love to hear about what else we can do in this space to help make your lives easier. Otherwise, David, thank you so very much. That was fantastic.
Thank you. Really appreciate the opportunity. Cheers.
And thanks everyone else. If you're not joining us for the rest of Finance Week, there's still 2 more webinars, one taking place tomorrow and on Thursday. Both of them are around funding. So yes, you can come and sign up to them. And as I said, yesterday's and today's will be on the Not-for-Profit Finance Week webpage. Thank you all so much, and we'll see you next time.
Thank you, folks.